President Donald Trump pausing import duties on a range of consumer electronics, lifting sentiment across markets, especially on Asian tech stocks. But after a number of head fakes, do investors still need to proceed with extreme caution? Live from Singapore, this is Inside with me, Haslinda Amin. We will dive deeper into Trump's latest tariff moves with crucial context and sharp analysis. President Trump and his team reiterate that the tariff pause on tech is just procedural until they move the sector to a different bucket.
All those products are going to come under semiconductors, and they're going to have a special focused type of tariff to make sure that those products get reshored.
The dollar falling to fresh 2025 lows and now expected to keep falling as the tariff impact shows up in hard data such as U.S. consumption, inflation, and labor market numbers. Meanwhile, President Xi heads to Southeast Asia, starting with Vietnam, to present China as a more stable partner than the U.S. during the trade war. We have a great lineup of guests to talk about the tariff impact on markets and the Chinese economy. 10Cap founder Junbei Liu will be joining us in a couple of minutes. Later in the show, we're joined by Shanghai Advanced Institute of Finance Professor Ning. Well, U.S. stock futures and Asian equities are bouncing back after President Trump signaled a reprieve on tariffs for consumer electronics. But he's now downplaying that as a temporary exemption. Trump also saying chip tariff rates will be announced over the next week. The tariff twists and turns, sending the dollar to fresh lows for the year. Avril Hong is here with more, and Avril, is a stock rebound that doesn't look that sustainable.
Absolutely, especially given these tariff headlines that keep changing. Earlier, it was the suggestion of some carve-outs. Now, the signals that these tariffs are still coming. And you're seeing these Asia stocks, along with U.S. stock futures, bouncing back. But this is cold comfort, given the steep declines just last week. On the Nikkei, on the TAIEX, you're still looking at double-digit declines. And the tech stocks, chip names in the region, they have paired the gains from earlier in the session. The Nikkei, the TAIEX, in terms of the double-digit decline that I talk of, it is for the year 15% still down. And amid all this, we're of course watching out for what's happening in other asset classes. Some have already pointed out that any stock rebound stability is going to be very tricky if we're still seeing these elevated treasury yields. You talked a short while ago of the data that's showing us the ramifications of tariffs, but also keep in mind how even though we're seeing some stability in treasuries, those concerns about deficit, inflation, they still remain, Has.
Well, that's right. We have now some data to point to the Chinese economy, some trade data out of China. China's March imports in USD terms falling 4.3% year on year. The estimate was a drop of 2.1%. So those import numbers weaker than anticipated. In terms of exports, of course, we've seen strong exports for China. March exports in USD terms rising 12.5%, 12.4% to be exact. Year on year, the estimate was for 4.6%. So it's slightly just a massive number for exports, rising 12.4% year on year. Estimate was for 4.6%. Let's get more on markets and that data with our guest who recently launched a new long-short equity fund with about $1 billion. Junbei Liu is founder and lead portfolio manager at 10Cap and joins us from Sydney. Junbei, first off, those Chinese data, I mean, the export numbers, exponential growth, almost 3 times more than anticipated. You can only imagine a lot of that has to do with front loading.
Oh, absolutely. Every company we've spoken to have talked about front loading. And, I was surprised the estimate was a little bit more conservative. So it's absolutely as expected. The import data was actually a little bit softer as well. But net, I think it's as expected that, there's so much uncertainty ahead of why not push some products through.
Some are suggesting that perhaps the Chinese stock market could outperform the rest of the world this year. What's your take on that?
Look, at the beginning of the year, we certainly think Chinese stock is going to do a lot better, just given the valuation disparity and given the economy is actually recovering from its really, really tough periods. And just given the US market, how much it's outperformed. So we thought Europe and China would do really well. Now, clearly, we have seen the US market fallen quite significantly, and particularly across some of the tech. So the valuation disparity is now coming back. While we continue to think China equity will do well, because it will be supported by its own domestic fundamentals, the stimulus towards consumer coming off from a lower base, and then also perhaps more stimulus if the tariff goes ahead. So, I think that domestically within China is still okay. But look, I think the US market actually have fallen quite a bit. So tactically, I think it's probably looking a little bit more attractive, but at least for the next quarter.
So am I right to deduce that you've been buying the dip in the S&P?
I'm certainly buying the dip, but I'm very selective. I'm a bottom-up investor, so you have to really work out, get on the phone. We spoke to so many of our companies, understanding where the uncertainties are and understanding where is the opportunity. I can tell you the opportunity lies in the company who doesn't get impacted by the tariff, yet much cheaper. So these are the businesses we're sort of looking at this stage. With tariff, it's just a little bit harder because sometimes it's a bit binary. And if it does come in, it will be horrendous for some businesses. And I think consensus analysts don't really have a good grasp of what it looks like. So I think that's a little bit early, but the rest of them, particularly some of the growth companies, looks really attractive.
Junbei, I'm just wondering why the U.S., why not more optimism when it comes to China? There's so much expectation we'll see massive stimulus, a bazooka of stimulus out of China, given how it needs to prop up its economy.
I do think that China is very attractive. Look, for the rest of the year, I think China is well positioned with the consumer coming off low base and activities picking up well, and then more stimulus to come. I think it's actually going to do well. However, it's really just tactically. I think the U.S. equity has been sold off quite a bit. Should we have any stabilization or or perhaps even lack of news flow on the trade front, the market should recover somewhat. We just need people to stop talking. But the thing is, look, there's still a bit of uncertainty, but just tactically, U.S. market looks, reasonably interesting. But for the rest of the year, China market should do well. Markets like Australia should do well as well, because again, the tariff impact is still somewhat small on the economy itself. And then we have the rate cut that just started. So look, I think Asian markets doesn't look too bad.
Junbei, we just have another line on those trade numbers. China exports to U.S. Rising 8.8% year on year in March, and that's according to a Bloomberg calculation. It's interesting that you talk about the economy in the U.S. Some, of course, are expecting that recession. They say that the numbers we're seeing in the S&P right now does not reflect that. Take a listen to what J.P. Morgan had to say.
It's really hard to change the confidence of businesses and households. And hence, that probability of recession is still up there at 60%. It's not 100% because you can see an overwhelming policy response. How many times have we been here during COVID or during the regional banking crisis when for sure we were barreling into recession, but the aggregate policy response was sufficient to stop it? We may see that this time, but for now, we're on path to recession.
Junbei, that recession, is it coming?
No, it's not. Well, look, we can, as he said, we can get off this path. It's not coming. We have Fed already talked about that they will step up to steps to support the market should there be more meltdown in confidence, confidence in corporate, confidence in consumer. So they're watching it. These are very strong language. They've done that last time when we were during COVID period. So I think that's a very strong vote of support. And also at the same time, should we have any deal done with any country, for example, with Europe or whether it's China, it is very positive for the market. So, look, our view is that these confidence number, yes, we will see another quarter of some softer, harder data, but consumer confidence can turn quite fast. With corporates, they just need clarity. Once you have clarity, you still have second half a lot of things to come. You have the deregulation to come. You have the tax cuts come through. It is still second half weighted. So, our view is that we just need stabilization. We need certainty. We need to know what the trade tariff look like. And then we just need the market to move on to focusing the fundamentals.
How are you protecting yourself against volatility? I mean, it's you look at the opportunities, but when you take a look at vol, we're seeing really massive volatility, both sides, on the up and the down. S&P, you know, we saw the biggest daily gain since 1939. When you take a look at VIX, went up to 60, then got dumped 19 points. How are you looking at vol? How are you protecting against volatility?
Well, that's a great thing about running a hedge fund. We can short companies. We can short companies that has exposure to a lot of those volatilities. And so in a way, it gives us the flexibility and agility to jump into companies we want to buy when everyone is fearful, at the same time managing our volatility. So we're in a great environment at the moment.
How much cash are you holding?
Look, I'm a hedge fund. I don't hold much cash. I hold 50 basis points of cash at any point in time. And I never run out of cash because I can short.
How much gold are you holding?
Oh, look, to be honest, I don't hold that much gold because I can only invest in equity. So I think physical gold is a better holding because gold equity itself represents quite a significant amount of risk. So we have a little bit of gold exposure through the gold equities, but it's not as significant. If anything, you know, probably net, there might be profit-taking territory.
Junbei, even as we talk about U.S. versus China and where to place your money, some say that given the tariff environment, India is actually the winner of it all. How are you looking at the Indian market? Is it now poised for a turnaround?
No, I think the opportunity here is, you know, it's absolutely in both the US and the China, where we talked about China fundamentally is improving. Over the next 12 months, things will get better. Yes, there will be tariff impact, but there's so much stimulus coming within the economy. It will be reignited. With the US, we just spoke about the valuation actually represent interesting, you know, entry opportunity. So I think that these two are still very, very interesting markets. If the US is heading to, you know, meltdown and the like, and other markets will be impacted. So same as the, you know, if China happens with China that way. So our view is that we'll continue to look opportunity in these two largest markets, and the current volatility really just giving you a buying opportunity.
What might prompt you to reverse course?
Oh, look, we've been watching essentially the financial condition. I know everyone's talking about the long bond yield. What's been happening there sounds like something technical. So we'll be watching that. I think as the equity is stabilizing, you know, we should see that reversing. And if the equity heading higher, we should see increasing, you know, sort of buying across those asset class. So we're kind of watching that. But at this point, we're not seeing significant risk in the financial tightening yet. We're also watching credit spread. It's not too bad yet. So you know, these are the metrics we're looking at the moment.
How are you assessing what's happening with the dollar? It's pretty unusual that when it is risk off, the dollar takes a dip.
Yeah, that's right. So I think that I guess what's happening is that people are using gold, right? So everyone's rushing out to buy more gold. I'm surprised that the Bitcoin hasn't made it there yet. So look, I think it's you know, it is a bit unusual. But remember, not very long ago, we were talking about how overvalued the dollar is. At some point, it's got to come back. So you know, in a way, it's perhaps not a bad thing.
And linked to that, of course, the yuan has been weakening. We have the PBOC fixing the currency at the weaker end of the band. How much room is there for further weakening in the currency?
Look, they will continue to move so, you know, to sort of stimulate the economy. I think the challenge is for China is that, you know, it's always a sign of confidence, right? When it weakens too quickly, too much and too quickly, then the confidence, you know, people lose confidence in within the domestic economy as well as the investment. So it's going to be a slow progress, but they will go as far as they need to.
And Junbei, of course, the optimism we're seeing in the markets today, driven by that delay in terms of technology tariffs. How are you playing this space in particular? Before we got here, of course, we talked about how DeepSeek has, you know, prompted a lot of optimism about Chinese tech stocks. Are they the ones you're looking at?
Look, Chinese tech stock certainly has still have very, very strong valuation support. And I think, that sector is still looking incredibly interesting, particularly government is providing a lot of support, at least publicly, is providing a lot of support for that sector now, like how, we're seeing the CEOs going around and talking to investors and the like. So that's quite unusual. And that simply means they have the government full support. And that's usually where you put your money in. And the valuations still look pretty good. But as I mentioned, the US tech, look, I think they got another tough quarter of the earnings, and expectation potentially still a little bit high, but their valuation has come off a lot. And I'm seeing the analysts already downgrading earnings for the tech company between 10 and 15%, which is have more than probably compensated by the share price fall. So I do think that the value is appearing in some of the US tech. As long as the tariff is not going to significantly change the earnings outlook,
What if the earnings season signal more weakness? Would that be a sign to perhaps, drop US stocks and look elsewhere?
Look, I think if there's signs of more earnings weaknesses, it's really represented by, and should the US equity fall further, I really think it represents the buying opportunity for those companies. Expectations was way too high, and then the economy was running too hot, and now everything has reversed. We have the, inflation certainly coming off, consumer sort of confidence coming off somewhat, and of course, we have the tech earnings now being rebased as analysts are readjusting down somewhat, and tech companies cutting costs as well. Remember, 2 years ago when they start cutting costs, we are seeing the stabilization of earnings. So I really think we're sort of in that point where, the expectations becoming more real, valuations become more real. We just need the stabilization of the tariff announcements.
Junbei, before I let you go, what's the one asset you should hold for 2025? We just had Goldman upgrading its target for gold to 3,700 from 3,300.
Look, asset you should hold, that will be certainly equities. I think that with the pullback, it's a great opportunity. Of course, within equities, there's a healthcare you look at, but be selective because some tariff, if it does come through, will impact some businesses.
Bring it on. Junbei, thank you. Junbei Liu, founder and lead portfolio manager at 10Cap. Thank you so much for joining us. Now, still ahead on Inside, an exclusive interview with DHL CEO Tobias Meyer, a company at the center of the global supply chains. Hear why he thinks tariff fatigue is setting in. Keep it here with us. This is Bloomberg. President Trump has pledged he will still apply tariffs to phones, computers, and popular consumer electronics, downplaying a weekend exemption announcement as a procedural step. And he says semiconductor tariff rates will be announced over the next week. Now, government officials also say the reprieve is part of a long-standing plan to apply a different, specific levy to the sector.
All those products are going to come under semiconductors, and they're going to have a special focused type of tariff to make sure that those products get reshored. We need to have semiconductors, we need to have chips, and we need to have flat panels. We need to have these things made in America. We can't be reliant on Southeast Asia for all of the things that operate for us.
What happened is, it's not really an exception, that's not even the right word for it. What happened is this type of supply chain moved from the tariff regime for the global tariff, the reciprocal tariff, and it moved to the national security tariff regime. It's not that they won't be subject to tariffs geared at reshoring, they'll just be under a different regime.
It was par for the course. Actually, it was a birdie for President Trump to do exactly what he did, which was pause for 90 days, and we're going to get this done for the American people.
A reprieve, not an exception. Well, for the corporate view, I spoke earlier with logistics giant DHL, which said industry leaders are already feeling fatigue over the fast-changing tariff rules. But CEO Tobias Meyer also told me exclusively the 90-day tariff pause on most nations gave some much-needed reprieve.
I think, Linda, we need to see what now is really happening. Obviously, there are certain goods that have been in transit, and for those companies, for those customers of ours, this is a big relief. It is a bit unusual that the relief was retroactive, so backdated to April 5th. So there's also now some work to be done with customs in terms of rewinding this. What's going to happen going forward is very uncertain. We heard those comments from the President of the United States earlier that they are looking now at electronics from a different angle of security, national security, the Section 232 of the US Code. So I think for our customers, there's still a lot of uncertainty out there.
The thing is, tariffs are coming. It just depends on how high they are. I'm just wondering, in terms of activity, are you seeing customers front-loading exports? What are you seeing?
I think in the last wave of tariffs being announced, that was not as big as we expected it and as we've seen it in the past. I think people getting really a bit tired. They don't know, even if something's announced, whether 2 days later it's not changed again. So you really see some fatigue of decision makers in manufacturing and also in the distribution sector.
Where's the pain being felt the most? Is it in the U.S. market?
Well, what we've seen is when in February the de minimis was gone, those shipments under $800 that currently don't require formal clearance, don't attract duties and taxes at all when it comes to imports in the U.S. When that was gone, the number of entries that Customs and Border Patrol had to process basically doubled overnight, and that was a real operational hurdle. I think now it's more customers, manufacturing companies trying to figure out where to put production, where to put inventory to best position themselves, and that's something that's very difficult.
So what are some of the considerations? Where are they thinking? What might it look like?
Well, I think there is the consideration what the administration of the U.S. is going to factor in. So whether they clearly they have the consumer in their mind. They don't want to see a big product launch being delayed, for instance. So that seems to be part of the calculus. It's very hard, though, for our customers to figure that out. So I hear a lot that customers simply say, we'll wait for now.
Are there now more disputes about who will pick up the tariffs, who will pay the cost, the additional cost that we're expected to see?
Well, firstly, I'm worried about the decision-making being delayed and that, those investments not being made, that will lead to some shortages somewhere at some point. So that's a negative for the global economy. I think that's clear. As it relates to the consumer, Linda, we have to see. The American consumer has been quite robust when it comes to these clear signs of volatility. Now, a lot is still to be seen when fashion now really becomes more expensive in the U.S. That's not a critical item, so people might just reduce. When it comes to more industrial goods or also consumer electronics, that is hard to substitute. So a lot of uncertainty.
That was my exclusive interview with DHL CEO Tobias Meyer there. Of course, in the markets, a new headline hitting this Monday morning. We have Trump posing on tariffs for electronics, prompting some optimism in the markets. Taking a look at where futures are right now, we're in positive territory, firmly in the positive. S&P futures up about 1%. Also gains for the rest of the benchmarks. The dollar, by the way, weakened to a fresh low for the year, and treasuries pretty steady, been pretty volatile when it comes to those yields, surging as high as 60 basis points and then getting dumped about 19. Taking a look at the dollar right now, the dollar index down about 0.1%. Still to come, we'll take a closer look at China's economic outlook as Beijing wrestles with a worsening U.S. trade war as well as sluggish domestic growth. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. We're seeing gains in the Chinese markets after Trump put a lid or pause rather, on tariffs on technology. Take a look where we are in terms of the CSI 300 index up by 0.5%, and the Hang Seng higher by 2.7%. Now, China said, of course, the reprieve is a small step toward rectifying the wrongdoings, urging D.C. to do more to revoke the levies and urging Washington to do more. Goldman, in the meantime, cutting the targets for key China stock indexes for a second time this month. Take a look where we are in terms of the Chinese yuan, 731.28. It is the weakest fixing since 2023, I think. And in terms of 10-year yields, 166 is the level we're looking at right now. Now, we also saw China's credit surge in March, driven by a jump in lending to businesses as well as stronger government bond issuance. This suggesting that policy support for the economy is taking effect. Meantime, China's exports rebounded in March, providing a boost to the economy ahead of the tariffs imposed by the U.S. Exports in dollar terms rose 12.4% from a year earlier, well above the 4.6% gain projected by economists. Imports, meantime, slumped 4.3%, worse than a 2.1% forecast decline that left a trade surplus of $102.6 billion last month. Let's get more with our Chief North Asia correspondent, Stephen Angle. That surplus is not going to sit very well with the U.S., Steve.
Well, I don't think the surplus is going to sit well on any month, obviously, for the Trump administration. They've already taken their action. Of course, 125% tariffs across the board on Chinese goods, plus the other 20% on the fentanyl issue. So I think this is just a punctuation point on the whole issue that the Trump administration has on the trade imbalance with China. And these numbers are skewed as well, because there was probably lots of front loading of orders before those tariffs took place. So that's why you saw a sizable jump up in exports. And again, is reflective of the weak Chinese domestic economy. Imports also fell more than expected. So a much better than expected surge in exports. That's good for the Chinese economy for now, but you're likely to see significant changes in those numbers starting this current month of April, but probably well into the second and third quarters. So it's just really beginning. Once there's, of course, the pause is taken off globally on these tariffs, increases across the board. The China Plus One strategy is under threat as well, and throughout Southeast Asia. So again, these numbers have to be taken with a bit of a grain of salt, a lot of front loading.
Let's talk about China's response to these U.S. tariffs. We know that Xi Jinping, for instance, seeking out Southeast Asia.
Yeah, Xi Jinping goes to Vietnam today. He'll be there today and tomorrow. Then he goes on to Malaysia and then Cambodia. And keep in mind, before that 90-day review or pause that the Trump administration put on those reciprocal tariffs, Vietnam and Cambodia had some of the highest percentage tariffs. We're talking 49% for Cambodia, 46% for Vietnam. I think Malaysia was 24%. So Xi Jinping probably going to turn on a little bit of the charm offensive to go into Southeast Asia, say, look, China's open for business. We are a champion of free trade. And just to counter the more protectionist sentiment coming out of the White House, and to talk to, his counterparts in Hanoi, in Phnom Penh, as well as in Malaysia.
That's right. And of course, Francesca will have more on that just slightly later. You got to imagine as well, the U.S. putting pressure on these trading partners to perhaps gang up against China.
Well, again, I think the Trump administration learned from the first trade war, where they didn't necessarily close off some perceived loopholes, where China did distribute some of their manufacturing to these other nations, Southeast Asian nations, whether it's Vietnam, as many people have done. They've diversified. Apple, of course, is diversified to both Malaysia and Vietnam and India and others. So China did the same to sort of get around any of those trade friction and tariffs from the Trump administration. Well, we all know that the Trump administration has taken that issue head on. Yes, there's a reprieve for now, a 90-day review period, but again, they're clearly in the crosshairs. And Donald Trump today is saying essentially no one is going to get off the hook.
Just a matter of kicking the can down the road. Steve, thank you. Our Chief North Asia correspondent, Stephen Angle there. Now, Footwear Distributors and Retailers of America, a prominent trade body, says it is not expecting Trump tariffs to revitalize U.S. manufacturing. Its chief, Matt Priest, told us earlier on the China show that any easing of tariffs on the sector will stand to benefit U.S. consumers and several Asian countries, including China and Vietnam.
Let's say they move forward with China and there's continues to be deal struck with the other countries. I can see Vietnam continuing to take market share. I can see Cambodia in particular, which is our #4 supplier, growing significantly. And you might even see some movement back into the Western Hemisphere, Mexico with USMCA access to the U.S. market, and maybe some other countries. I do not see a massive reshoring of production to the U.S.
As we said earlier, President Xi Jinping due to begin a Southeast Asia trip today in Vietnam, stepping up efforts to court allies in a trade war with the U.S. Before his trip, President Xi wrote an article for Vietnam's Nam Dang newspaper saying the trade war will produce no winner and protectionism will lead nowhere. Our two countries should resolutely, he says, safeguard the multilateral trading system and cooperative international environment. Bloomberg's Vietnam Bureau Chief Francesca Stevens joins us now from Hanoi. Francesca, what can we expect from Xi's visit?
Hi, Haslinda. Yes, Xi Jinping's expected to arrive in the next few hours here in Hanoi, where he'll hold talks with top leaders, including Party Chief To Lam, Prime Minister Pham Minh Chinh, and President Lung Kung over the course of his 2-day visit. It's Xi's second trip to Vietnam in less than 18 months. And by making Southeast Asia the destination of his first overseas trip this year, the Chinese president is really signaling Beijing's intent to deepen alliances here in response to the Donald Trump tariff threat. Now, Chinese investment has poured into the northern industrial parks here, where companies like Foxconn and Luxshare have large factories making components for brands like Apple, as Steve said. The economy is heavily reliant on Chinese parts and raw materials, and the two sides are working to develop infrastructure to connect them more closely. Now, over the weekend, we saw the government here vow to speed up progress of 3 railway projects connecting the two countries. This includes an $8.4 billion cross-border railway that will link the northern city of Lao Cai to Hanoi and Haiphong port city, and that's set to be completed this year, and we expect that to be on the agenda during the 2 days of talks.
Obviously, a lot at stake for Vietnam. It was imposed with 46% tariffs. What's the latest on Vietnam's push to trade talks with the U.S.?
Yeah, as you said, Vietnam's leadership has been working furiously behind the scenes to avert that tariff, that 46% tariff. After a visit by the trade minister in March, the deputy prime minister, Ho Duc Phuc, spent last week in Washington holding last-minute crunch talks with Treasury Secretary Scott Bessent and the Commerce Secretary Howard Lutnick. And that urgent diplomacy appeared to bear some fruit. During that trip, Vietnam and the U.S. agreed to start negotiations on a reciprocal trade deal. The breakthrough came just hours after Trump had announced the tariff pause. So the two sides have agreed to consider minimizing non-tariff barriers to each other's goods, as well as strengthening coordination to control and prevent acts of trade fraud. Now, Vietnam was among the first countries singled out by Trump for showing willingness to negotiate over the tariffs following a phone call between the US leader and the Communist Party chief To Lam. Exporters now closely watching the trade talks and banking on the government's ability to navigate a way out of this crisis.
Francesca, thank you so much for that. Bloomberg's Vietnam Bureau Chief Francesca Stevens there. Well, our next guest is a globally recognized expert on China's economy and financial system. He also provides consulting services to governments, regulatory agencies, and major corporations worldwide. Joining us from Beijing, Ning, Professor of Finance at the Shanghai Advanced Institute of Finance. Good to have you with us. I'm just wondering, when it comes to that tour of Southeast Asia by Xi Jinping, how much do you think he can achieve from those visits, bearing in mind that these countries are also under a lot of pressure from the U.S. to perhaps turn the other way from China?
Well, I think given the uncertain situations that has been developing over the past months or so, I think China is doing everything in its capacity, trying to strengthen its relationship with its neighboring countries and also with many of the countries that it has made a lot of investment into. I think it is going to be tricky because, I mean, as some of the experts pointed out, I think part of the purpose of this time's tariff is targeted at trying to fill up some of the loopholes that China has been taking advantage of left by the Trump 1.0. So in a way, I think it is not as easy as before, but then I think President Xi is going to put a lot of emphasis on, I mean, it's not just trade or investment. There's also a very delicate diplomatic and geopolitical rebalancing in the entire region. So I think all those matters have to be taken into consideration at once, all at once. In trade is just being part of the discussion. I think there are definitely more areas which the mutual or bilateral leaders are going to talk about in those meetings.
How crucial is this visit to Southeast Asia, bearing in mind that the WTO has said that with the tariffs, 80% of U.S.-China trade will be wiped out?
I think it is quite important. I think in a way, China's export to the U.S. in recent years have only been accounting for about 15% of China's total export. For example, I think for the year of 2023, China's export to emerging economies surpassed that of its export to the G7 countries. So in a way, I think the export to emerging markets and sometimes through emerging markets back to developed countries are crucially important to China's export and economic growth in general. So in a way, I think Chinese companies have been trying very hard over the past couple of years, maybe even longer, trying to invest in emerging markets, trying to circumvent some of the potential tariffs that's going to be imposed on Chinese exports. So in a way, I think that is very important about how China could work with some of the countries some of the countries in Southeast Asia or in other emerging parts of the global economy, trying to deflect the total pressure coming from the U.S.
Ning, sometimes we overlook the fact that millions and millions of jobs are at stake in China too, because these jobs are linked to the export to the U.S. Quantify that for us. How big a damage that might hit China?
I think some people have been doing the calculation about, so assuming that China's export to the U.S. account for about 15% of its total growth, of its total export, and then export account for about 20% of China's total GDP growth. So in that regard, we're talking about 2 percentage points at stake in general. But then, of course, that is assuming total substitution and no elasticity. So I think the ballpark number is about 1 percentage point of the GDP growth for China going forward. And to what extent that can be absorbed in China's investment into the U.S. directly or into other third countries indirectly, I think that's a question. Then, of course, the key question we just talked about is also about to what extent other countries will be influenced by the tariffs, or will there will be more and more exemptions coming out of Washington, D.C. to alleviate the pressure. That's probably secondary pressure on China's export. So I think there is a shock to China's export and employment. But then I think we should not forget about its potential impact to China's inflation, to the U.S. inflation. And if the inflation stays high enough, or if the expectation for inflation stays high enough, then the Federal Reserve will be put into a very delicate situation about its original plan of lowering interest rates. And without a much lower interest rate, the U.S. will be facing a great pressure on interest rate coverage with its treasuries. So I think it's a chain reaction to a lot of changes, not just on the China side, but also on the U.S. side as well.
Let's look at the latest trade numbers out today. Exports coming out really strong, almost 3 times stronger than anticipated. But this is a lot of front loading. I'm just wondering, in the coming quarters, what can be expected? What will be the true numbers?
Yeah, personally, I'm not too surprised by the very strong export number in the first quarter. I think there are at least 2 factors at play. One is, Haslinda, as you pointed out, that's the front loading in anticipation of the potential tariffs coming from the U.S. And 2 is the Spring Festival factor. I mean, Chinese always try to expedite their production and export to their customers right before Chinese New Year. So I think those 2 factors work together, paint a fairly strong export number despite the recent tariff pressures. But going forward, I think it is quite important that we keep in mind that even with this constant decrease over the past decade, export remains as a very important component to China's GDP growth. And also, I think over the past 3 years, export has been a critical component for China's achieving its growth target of about 5%. So in that regard, I think going forward, China's economic growth will be impacted without a doubt. That being said, I think China's policymakers are also watching this matter very vigilantly. And I personally don't think they will wait until July, which is a typical time for the Politburo meeting to review the half-year economic activities of the country. I think they will probably meet earlier and expedite and expand the potential range of stimulus, trying to bring the economy back to its track. So I think two major areas we can easily think of. One is, of course, consumption, more stimulus, more subsidy, more trade-in goods. And then another is probably infrastructure investment and the social welfare programs. I mean, in my view, it does not necessarily mean more railroads, more airports. It could mean better sewage system, better schools and better hospitals for the netizens.
If exports remain really important to China, I'm just wondering if China can find alternative markets. Lots of anticipation in markets like Vietnam, Thailand, and the Philippines, even about cheap Chinese products getting dumped in those markets. And linked to that, what does this all mean for China's growth? We have the likes of Goldman already cutting the growth projection for China to perhaps 4.6%. What are you looking at? What are the implications?
I think for the time being, given everything that we have been seeing, I think the Chinese authorities still cautiously optimistic with achieving the about 5% growth target that's set in the two sessions back in March. I think it is important and it is going to hurt China's overall growth. But then I think there are also a lot of tools and ammunitions in the toolbox of Chinese policymakers so to offset some of the headwinds that China suffers from the trade side. And you brought up a very good point about, I think, the bilateral relationship between China and the U.S. is largely set for now with what has happened over the past week or so. What's remaining uncertain is, especially with President Xi's recent trip to Southeast Asia, is how would China work together with other countries which are also being impacted by the U.S. tariff policies, trying to work together to reshape the global trade system and also trying to deflect some of the pressures or the heat coming out of Washington, D.C.
There's a lot more tolerance for a weaker currency. We saw that in the fixing today. I think the weakest fix since, 1986 or some sort. How much room is there for further depreciation in the Chinese currency, bearing in mind that Trump has already warned against currency manipulation?
Right. I think that's probably, the warning from the U.S. is probably a very important factor which the Chinese policymakers would have to take into consideration when they think about devaluing yuan. I think it is economically sensible for Chinese to devalue to a certain extent, both to balance the trade and also to encourage Chinese exports. But I think that said, I don't think there's a huge room for China to move in that regard, especially given that, well, if China were to do that, then other countries, such as countries in Southeast Asia, may be feeling the pressure and engage in a competitive devaluation of its own currency. So I think that's one very tricky topic that we would have to watch and see. Another very important topic that we have to be very mindful of is, I think EU came out last week saying that they're very concerned with China might be directing its capacity towards EU if its export to the US is being blocked or being restricted. So I think that is also a very important area which Chinese policymakers and diplomats would have to work very diligently to negotiate with the EU authorities on that front.
Ning, great insights as always. Ning, Professor of Finance at Shanghai Advanced Institute of Finance. Now, still to come on the show, Singapore's central bank eases monetary policy, sounding the alarm on the trade war's growth impact. We have details next. Keep it here with us. This is Bloomberg. Well, let's take it back to the Lion City. U.S. tariffs are clouding the outlook for global activity. Singapore's central bank has joined others in the region that have eased policy amid risks to growth. The MAS downgrading its 2025 forecast to between 0 and 2% expansion, down from 1 to 3%. April's back with more. Of course, we're seeing growth risks and then easing. The second time this year. We're talking about the second time here in April.
Yeah, I mean, we saw it in January, now we're easing again in April, but Singapore's MAS really joining the central banks in easing mode. And a lot of this, of course, is that focus on growth. Given how trade reliant this economy is, we have it multiple hundreds times of GDP, the trade accounts. And against this backdrop, certainly there are these risks to growth, given how not just the manufacturing and the trade-related sectors could take a hit, but it's also, if you think about the global risk of what that might mean for trading activity in the global financial hub. Does this affect the finance, the insurance-related sectors? So this downgrade to the growth forecast from 1 to 3% to 0.2%, meaning worst case scenario, we see no growth at all this year, or 2% on the best case. But some are saying that they don't see recession odds just yet amid all this, including the likes of Maybank, because they think that there could be more fiscal support later in the year. They're seeing a construction boom as well, and then the 90-day reprieve, something that they think is still supportive for growth. So they don't see easing even in the second half of the year, which contrasts what the likes of Bloomberg economics believe, which is we will see yet more easing from the MAS, given the cut to the growth forecast this year, that we could see in July, October, yet more easing.
And of course, it is election year. People are talking about more support on the back of that as well. You got to wonder the impact on the Sing dollar and how the MAS is looking at the currency.
Yeah, it's interesting. I mean, you look at the Sing dollar and how it has performed so far this year, topping the chart, second only to the yen in the Asia Pacific, and it's hovering at a 5-month high. And this is coming despite easing today from the MAS. But as some traders have already pointed out, you look at the form of easing that it has deployed, perhaps the least aggressive in that it is reducing the slope of the Sing dollar appreciation. It's not adjusting the width. It's not recentering the band. So maybe a bit of comfort for traders, helping the Sing dollar to be supported. And don't forget, in this part of the world as well, the Sing dollar has a safe haven sort of quality. So all in, that expected continued outperformance. Not to mention,
what we're looking at in terms of inflation in this part of the world as well. In Singapore in particular, we know the Singaporeans often complain about how high prices are, yet when it comes to inflation, the government is not that worried.
Yeah, and it's actually the MAS today lowered its core inflation outlook for the year. It also sees domestic import cost pressures as remaining low. So it's really interesting that even though the cost of living concerns still weigh on the minds of voters in an election year, that MAS, I think, still sees core inflation remaining benign for the rest of the year, slowing even, and that potentially giving it more space to ease if needed.
That's right. But we still feel the pain. April Hong, thank you. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.